So thanks again for joining us on Lessons into Blessings podcast, where we are leveling up investors in their financial freedom through sharing stories and strategies of everyday people who've changed their trajectory through real estate. I have with me Charles Seaman, managing partner of Cash Flow Champs. He's a multifamily real estate investor, strategic partner, and mentor that specializes in multifamily real estate underwriting, asset management, and optimization and market analysis. Charles has a background in commercial real estate and is passionate about democratizing real estate investing for all individuals. And for me, before I introduce you on Charles, I've learned about you through kind of the Saturday Zoom call. Someone referred it to you and said, hey, if you want to learn about just the beginning stages of underwriting, that's kind of how I found out about you. And I think you have a wonderful heart to be able to take a few hours out of your time on every Saturday to be able to share with students and investors that are getting into the game at no cost. So we're going to be talking about underwriting, and I would love for you guys to welcome Charles Seaman on the show.
Terry, thanks so much for having me. It's a pleasure to be here and a pleasure to speak to the audience.
Yeah, no worries. So we always get started trying to, having people kind of share a little bit about their journey. And then we'll get into all things underwriting. But I wanted you to really just share about like how you jumped into real estate and how you kind of got on the underwriting track. Because we know that that really the multifamily space and real estate is a team effort. But how you honed in on underwriting and asset management and some of the areas that you specialize in, and share a little bit about that journey.
Sure. I probably had a little bit different of a path. So for me, it wasn't something that I started actively seeking out. It looks like my camera is going haywire. Can you see it on your end?
Yeah. Mm-hmm.
Okay. So I took a different approach. When I was 20 years old, what I tell people is I was young, dumb, and broken. It wasn't so much that I was aspiring to be a commercial real estate investor. I was looking for a job. And at that time, the job that I wound up with was actually working for a gentleman that I was a friend of the family of. And, at that point, I didn't really know where life would take me. And the gentleman that I worked for, he owned several different businesses and properties. He owned a plumbing company. He owned commercial real estate. He owned bars and restaurants and a few other little odds and ends. And when I first started there, I had my hands in all different things, and my role eventually grew to helping him manage all of his different businesses and properties. So it gave me exposure to different industries. And, when I first started there, my plan was to stay there for 2 to 3 years, but sometimes in life you get lost along the way. I started making a little more money. Perhaps I thought I was important. And, next thing you know, the 2 to 3 year plan turned into 14 years.
Right.
And I was fortunate to make a lot of good connections and to learn a lot and have exposure to different industries. So those were all good things. And during that time, it was also at that point that I realized real estate was the path that I most gravitated to of the industries I was working in. And construction can be highly lucrative, but it's also highly stressful. Not to say there's not stress in real estate, because there is, but it's a different type of stress. And I kind of like that stress better. So for me, I knew that I didn't have the money to go out and do commercial deals. By the point they'd been at my job for about 10 years, I started dabbling into single family and wholesaling, and I hired a mentor. I took some courses. And what I realized was 2 things fairly quickly. One, I didn't like it. And 2, I wasn't good at it.
Right.
And it's not to say that I couldn't have gotten better at it. I'm sure that I could have if I worked at it. But I was kind of deflated because I'm saying, boy, at work here I am doing these big commercial deals, and now I'm going out of my spare time and I'm starting with single family homes. I said, this is kind of deflating. So I took a step back and I was reevaluating where I was. And then, in 2016, I discovered syndication for the first time. And at that point, I really didn't know what syndication was, but I started learning about it. And I said, oh, this is good. This allows me to take the skills that I already have. It allows me to do the deals I want to do, and it allows me to use other people's money. So this is kind of a win-win scenario that gives me the best of all worlds. So
what's the skills that you realized you had when you took that?
The skills that I realized I had was relationship building. I'm definitely a good relationship builder. It's one of my strong points. So while relationships are important in single family, a lot of times you can find deals are more transactional in nature. In
Right.
commercial, it's the total opposite. You're going to be dealing with the same people over and over and over again, especially multifamily.
Yeah.
Pretty much any multifamily market in the country, you probably have anywhere from maybe 10 to 25 people that really control the deal flow in any given market. So it's not a big pool. So you
Yeah.
have to build deep relationships. You have to be able to really go deep and get as far as you can, because most of the deals that I've won have been because of good relationships.
Yeah.
It's also just understanding how the numbers work. So, while there are some similarities between single family and multifamily, there's also some differences. So, where the differences come in are in the nuances. And the nuances of multifamily and commercial real estate financing are a lot different than single family.
Yeah.
So, I was used to dealing with commercial just because I was working with those things in my full-time job anyway. So, those are pieces of information I already had and expertise I already had, as opposed to needing to go out and develop a new skill set.
That's good. That's a good leg to start off on. And I feel like people should always be understanding what their, some people call it superpowers, or what are the things the assets that you bring to the table, so that you can find your space and your niche when you're jumping into the syndication space.
That's definitely a very important thing. No one person can be an island. Always keep that in
Yeah.
mind. So you need
Yeah.
to figure out what you're good at and just get even better at it. And
No,
then get
that's real.
other people to help you fill the gaps in.
Yep, absolutely. So from an underwriting standpoint, when I first heard underwriting, I started in the single family side as well. And then I jumped just recently in the past few years, jumped into multifamily. And so when I heard underwriting, you think about it traditionally, hey, I want to buy a house. I'm going to get a loan. And then when I go to the bank, they will typically pull all my information, my income, my assets, they'll look at all the property details and information. And then they'll tell you, okay, we're still processing your loan, and it's in underwriting, right?
Yep.
And so the bank has this person who it seems like it goes into a black hole, right? So it's waiting with the underwriter, and they're making a determination on if you're a good candidate, right, to pay back their loan, and all sorts of these details that come into place. How is that? So that's kind of what I've thought of an underwriter. I think most people, when they hear underwriting, either don't know what it is, or they've just like, okay, yeah, what does the bank have to do with this?
Yeah.
So can you
I would agree with
explain
that.
what underwriting is from an investor standpoint, who's now analyzing a deal, probably looking at some of similar details as a bank would look at when they're looking to give a loan to an investor? How would you kind of describe what underwriting is from an investor standpoint?
Good question. So I would actually say it's very similar to what it is on the lending side and also on the insurance side. So
Mm-hmm.
the way I describe underwriting is I say you're taking the existing income and expenses, and you're essentially assessing the financial viability of the deal. So in layman's
Mm-hmm.
terms, you're taking the numbers the seller or broker gives you, you're putting them into your underwriting tool, and you're seeing whether or not the deal makes financial sense.
Yeah, that's good. And so for the differences between what you've seen on the single family side and multifamily side, what's the pivot that people have to make in their mind when analyzing a single family deal versus a multifamily deal?
So typically with 1 to 4 residential units, for lending purposes, that's going to be qualified under the residential side. What that means is valuations are primarily based on sales comps in the area. When you go residential 5 units or more, it's then considered commercial. And
Yeah.
what that means is based on the income of the property and not necessarily the sales comps.
Yeah. That's really a beautiful thing, right? Because on the single family side, we were really focused on net operating income, cash flow. How much can this deal cash flow to me? We really don't know what the future is. We're kind of projecting. You never know what the future is on any side of the house, but you're projecting, okay, this area will appreciate by so much, but really it's the net operating income and the cash flow. On the multifamily side, you have that opportunity from a value add standpoint to kind of force the appreciation, because it's valuated on the income. So can you talk about just strategies of how you can really make a deal work
Sure.
based on? Yep.
So, similar to what you're saying, one of the popular strategies out there is value add. So what is value add? Value add is anything that can be done to increase the property's net operating income. And for anybody brand new, net operating income is your operating income minus your operating expenses.
Yeah.
And the reason that number is important is because that's the number that's typically used to value commercial property. So if you go in and you buy a property that has a net operating income of $100,000 and you see an opportunity to go in there and push rents, let's say that you see a big opportunity, you can go in there, you can push rents, you can decrease expenses a little bit. So all of a sudden you take that $100,000 and you turn it into $120,000. What you've done is you've increased the net operating income in that case by 20%. So that's a pretty sizable jump. Now, does that mean you're going to have a 20% increase in value? Not necessarily. It could, but there's another part of the equation. The other part is the cap rate. So the cap rate is going to be driven largely by the market, but the net operating income is within the control of the operator, and that's the part you want to focus on. You can't control what the market does, but you can control how the property performs, and that's something you want to be very aware of.
Yeah. And so how in this market, and we'll talk about just some of the factors and the things that investors should be looking at when they're underwriting a deal. Has the cap rates done, and that's we could go on that track, but it can get muddy and it's a slippery slope.
It can, but it's probably an important one.
Yeah.
So it's something I often mention during the underwriting sessions, especially the recent ones, as we have some very interesting market conditions right now.
Right.
So to your point, we're at a time where most markets are seeing cap rate decompression. So what that means is cap rates are rising. So cap rates and price have an inverse relationship. When cap rates go down, price goes up. When cap rates go up, price goes down.
Right.
So depending if you're a buyer or a seller, it could be a very good time or it could be a very bad time. If you're a buyer, probably a very good time. Cap rates are decompressing. That means prices are coming down. If you're a seller and you have a need to sell, probably not a great time right now. So what that means is for somebody who's brand new, if you don't have any assets yet, now's the time you want to be getting ready, because as you see cap rates decompress, prices are coming down. And a large part of that's driven by the debt markets right now. Yeah. So we're seeing a lot of turbulence in the debt markets, and that's largely done to combat inflation. So what's happening is the Federal Reserve Board has been raising interest rates at unprecedented speeds in recent history. And because of that, we're seeing property values change significantly. There was, just to give an example, a practical example. So let's say if you have a property that you bought with a $100,000 net operating income, and let's say that you bought that property at a 3% cap rate, which a lot of deals last year and probably earlier this year were trading at 3% cap rates in many markets. Right. So in that case, your property value would be $3,333,000. So now let's say you see some decompression. Let's say that you haven't really done much to the property. You still have that same $100,000 net operating income, but now you've experienced some decompression and cap rates are at a 5 in that market instead of a 3. So all of a sudden your property went from being worth north of $3.3 million to $2 million. That's a substantial haircut in valuation.
Right.
So something important for people to understand, so you can only control the part you can control. Market conditions are beyond any of us, but you want to use your best diligence when selecting markets, so that way you're picking good markets to get into and reducing the probability of that happening.
And I would even say that just the debt equity, just because of where the interest rates are, that's definitely a big major thing to be looking at, because if you were analyzing a property a year ago versus a property today, it could have maybe, property to property similar cap rates, but from a debt standpoint, it could easily make the numbers not make sense anymore. So
right. And to give a practical example, so there's a property I looked at that I had as an off-market deal in April, and they were looking for $21 million at that time. I did not wind up buying it. In retrospect, I'm quite thankful. That property is currently on the market And now they're looking somewhere between $15.5 and $16.5 million. That's a $5 million loss in 7 months. Keep that in mind, guys. It's very tough to recover from that, regardless of how good an operator you are.
Right.
But it also means
so with that being said, what are the opportunities that you see now with that in mind, right? So now, what is critical to be able to take down a deal? Now, because they're getting those haircuts, it provides new opportunities for investors. Where are you seeing the opportunities for investors to really be able to take advantage of that? So obviously the debt is still what the debt is, right? So
it is.
Yeah.
And that's changing. So, right now, as we record this in late November, nobody knows exactly how much further we're going to go with rate hikes, but there's a reasonable expectation that there's probably 3 more Fed rate hikes left. So what does that mean? It means that interest rates are going to continue to rise. So even if you get a deal on the contract today, there's a good chance you may wind up with a higher rate by the time you close. So you want to build some of that into your underwriting and do the best you can to be forward looking, but not so forward looking that you're not going to get a deal. So, we're at an interesting time in the market. And I think in many cases, sellers who want to sell aren't selling because they're not getting their numbers. Somebody bought a property last year or even in 2020 and they paid a premium price for it and they don't have a need to sell. They're probably not going to, because they're probably not going to get their number in most cases. Now, some sellers are getting creative. So that means they're open to seller financing in instances when they normally wouldn't be. So using some creative financing, different strategies are ways that people are getting deals done now.
Yeah.
But what you're going to see, you're starting to see a little bit of already, but you'll definitely see even more of it in the coming months and years, is sellers who need to sell. They're not going to have a choice.
Right.
Why do they need to sell? So a lot of them acquired assets with bridge loans, and most bridge loans have 2 to 3 year terms. Some of them have extensions built in there as well. A lot of these loans were acquired. A lot of these properties were acquired in 2020, 2021. So a lot of them are coming due in the next year, the next 2 years, the next 3 years. So what does that mean? Well, if you bought a property and you took out a bridge loan and you had a 3.5% interest rate, which not that uncommon. A lot of them had 3s and 2.5s even. And now you're refinancing it, and maybe that interest rate somewhere in the 7s. That valuation probably isn't going to be there. Regardless of what you did to the NOI at the property, there's a good chance the valuation won't be there. So as a seller or an owner, if you're not well capitalized, that means there's probably going to be tough times ahead.
Right.
As a buyer, what that means is get ready, because there's going to be some great deals ahead.
Yeah.
So in many cases, sellers who want to sell aren't going to, because they're just not going to get their numbers. But sellers who need to sell aren't going to have a choice. And many times it'll be with their back to a wall, because it's either get foreclosed on, destroy their credit, lose the money, or take something and walk away.
Right. Understood. So let's jump into that's great info, by the way. Let's jump into kind of the underwriting details. Is there, and especially in the time, right, as investors are getting ready, what are when we're going to jump into a little bit more of the details, some of the factors and the parameters that investors should be paying attention more now, a little bit more scrutiny. But what are the things that investors should be doing before they're even in the underwriting process, right? Like honing in on, what type of deals are we taking down? Where are we taking down the deals, and how to really set their goals appropriately so that they can really hone in on their underwriting, right? Because you could underwrite any and everything, right? And that could, you'd spend a lot of time. How do you focus on goals, and how do you advise your students to kind of focus on goals?
Sure. So for underwriting specifically, the first thing you want to do with anything is learn. Now, when I say learn, you want to get a basic foundation. You don't want to become an expert, because the amount of time it's going to take you to become an expert is going to be substantial. So You'll become an expert through practice and through experience and through doing things. But you want to learn enough to have a foundation that you have a basic understanding of what you're doing. So you also want to be building good relationships because that's going to help you build your deal flow and give you more deals to underwrite on a consistent basis.
Yeah.
For me, all of my deals come from broker relationships. So, treating brokers good and being able to, get deals from them is important. If you're looking at deals that you go direct to seller with, then you want to be able to have something that's going to allow you to bring deal flow in.
Yeah.
So right now we're in kind of a unique time because of the market conditions, but it was also an opportunistic time. So there are some things I would tell you that you want to look at every time, regardless of market conditions. But then there's a few things right now that I would say you want to be extra cautious with because of the time period we're in. And with those items that you want to be extra cautious on, the first one I would tell you is your interest rate. Interest rates are rapidly changing. So if you're underwriting deals to what rates are now, and we have potentially 3 more rate hikes ahead of us, that's probably not a good idea. So what that means is, let's just use a random example and say if interest rates now are 6.25%, then you go out there and use that in your underwriting. But now you go out and you win that deal and you have, 2 to 3 months to close it. And during that period, we have 2 more rate hikes. And now interest rates are at 7 or 7.25, and the deal no longer makes sense at the price that you got it at.
That's good.
That wasn't good, because is there a chance that you can go back to the seller and say, hey, look, Mr. Seller, the market has changed. I underwrote the deal at this, and now it no longer makes sense. I need to get a credit. So you can do that, and sometimes you may be successful with it, but other times you may not. And by that point, your deposit money is probably non-refundable, and it's going to cost you a lot of money to walk away from that contract if you no longer like that price and terms. So be cautious on the interest rate. Be aware that interest rates are still rising. And as you're underwriting, use some forward-looking perspective in that so you can have a safety net. Another thing I would say to be very cautious on is rent growth. And that's obviously a hot button topic because, it's rather unusual, but we're seeing rents start to drop in many markets across the country. Now, do I think we'll have substantial drops? Probably not. But rent drops in and of themselves are very, very unusual. And even when you see property values drop, a lot of times you don't see rents go down.
Right.
But this time's a little bit unique. Why is it unique? Well, for many markets in America over the last 2 years, we've had double-digit rent growth each of those years. In some cases, double-digit, wasn't just 10%. Some of them was 20, 30. Some of them even pushing higher than that, depending on which publications you read. So when you factor in that most markets in America probably had at least 20% rent growth over the last 2 years, that's a substantial amount. So historical norms for most markets are probably 2 to 3%. So when you factor in 20% in 2 years, we basically had a decade's worth of rent increases in the last 2 years.
Yeah.
What does that mean? It means that a lot of people can't afford it. So if you're buying luxury properties and you have strong tenant demographics, probably not as much of a concern. I mean, I'm sure eventually they'll feel the pinch, but not immediate. But if you're buying C-class assets, which I'm sure a lot of people on here are, then that demographic is going to be very affected. So if you go in there and you're assuming that you're going to be able to bump rents, 5% with an organic increase in year 1 and 5% in year 2, that's probably very unrealistic. Now, is it to say that you can't get a value-added bump? So keep in mind, guys, rent growth is based on 2 things. One is the organic growth, and that's usually a cost of living increase. And the second is any value-add growth. So if there's some type of opportunity where you can go in there and you could increase the rents because there's a clear imbalance between what this property, the subject property is charging and what the other properties in the area are, then you can still probably achieve that. That's okay. But be careful with the organic rent growth in particular. So for me personally, I'm using 0% for year 1 and 2 right now on the organic side. And then I'm going back to 3% in year 3, just to account for the fact that we may see some either rent decreases or even stagnant growth over the next year or 2. So just be cautious of that, because if you're projecting these big increases, you may be very disappointed. And the last thing I would tell you right now to be really careful with is terminal cap rate. So aside from purchase price, I would say terminal cap rate is probably the second biggest factor in your deals. And a lot of times it's going to influence, what you're willing to pay for it. The challenge is it's also one of the things we can't really control. So
and explain terminal cap rate, just
yeah,
so people understand that.
absolutely. So cap rate itself is your net operating income divided by your purchase price. So when you call it a terminal cap rate or an exit cap rate, what that means is that's the cap rate you're projecting when you go to sell the asset in the future. So in general, you do want your terminal cap rate to be higher than whatever the market cap rate is for similar assets at the time you're buying it. But you also want to be cognizant, because right now we're in a period of cap rate decompression, and there's a lot of speculation out there. Some people are expecting, just minor decompression. Some people are expecting major. So take everything with a grain of salt, do your homework, and make your best judgment based on the information in front of you. So
what are you assuming, just in general, terminal cap rate in today's market? Are you thinking 0.5, maybe higher, percentage point higher than?
I would say higher than that.
Mm-hmm.
To me personally, I'm probably more bearish than most. So I would say I am varying it from market to market. I would also say it's a moving target. So if you would have asked me 2 months ago, for me, I look primarily in the Southeast markets. Now, keep in mind, guys, cap rates vary from market to market. So the cap rate in Charlotte's going to be different than the cap rate in Indianapolis, and that'll be different than the cap rate in New York. So in the Southeast markets, strong markets like Charlotte and Atlanta, 2 months ago, I would have felt okay with the 5.5. Now I'm using a 6, because I want to bump it up more. And I'll probably continue doing that as we see conditions adjust. So one thing you want to do is just be keeping up to date with information, because information is moving very fast right now.
Yeah, it is.
And you want to be adjusting your strategy as new information becomes available.
Yeah. So you said a lot of things in there. What are some ways that, so one was the affordability ceiling for really C-class properties and C-class type of tenants. I definitely feel that, because I own C properties, and I'm seeing more delinquencies now than I have even during the COVID time period. So I definitely believe that's a real thing. And, so making sure that those rental assumptions are really, accurate. The other thing is keeping up to date with the market. What are some of the things or places that people should go to really stay up to date? And so I'll just target one on the rent side. Is there a place they should go to say, hey, if I'm looking at a C or B class property, is the income in this area, based on where I want to take and project the rents to be, is the income in this area going to be able to afford that? What are some of the places and things and stuff like that you go to kind of stay abreast of what's going on in the markets that you're interested in? And they may be different market to market, but just.
Yeah. So for me personally, I probably take a more old-fashioned approach than most. A lot of my stuff is done by speaking to people.
Yeah.
So it's speaking to brokers, speaking to property managers, speaking to lenders, speaking with mortgage brokers, people that are doing this every single day and they're in the know. Yeah. Now, can you get good information from data services like CoStar and Yachty Matrix? Absolutely. The challenge with any data service is there's always a lag, because even the best run data services can't update things instantaneously. There's just too much information on an ongoing basis, so it takes time. So oftentimes you will get more up-to-date information by speaking with people that are in the field every single day doing it. That's good. If I want rental information for an area, I contact the property manager. If I want sales comp information, I contact the broker, also for information on cap rates. If I want to see what financing terms are looking like, I go to mortgage brokers and speak with them. So that way it helps me stay on top of these things and be aware of what's changing in the market.
That's perfect. I mean, and you talked a little bit to that, just the relationships that are important and are critical when you're doing underwriting and all of those avenues. Is there any other critical relationships that you believe is really key to make sure that you're staying on top and making sure that when you're underwriting and analyzing a deal, that it's as good as you're going to get, right? As far as
yes, there's two more that I would throw out there. The first one would be a good insurance broker as well. So you want to be able to have an insurance broker that you can bounce information off of to get good insurance rates. Insurance premiums are moving very rapidly, just like everything else in the finance world at this point.
Yeah.
And then not necessarily not necessarily a relationship, but somebody else you want to reach out to is the tax assessor in the county that you're looking in. Now be
No, that's
careful.
good.
You don't want to build a relationship. You could violate laws doing that, but get information nonetheless. So, and this is whether it's good times or bad, making sure that you have good information for your property tax reassessment is very, very important. So to put in perspective, there's a lot of deals that I've seen killed solely on tax reassessments.
Wow.
And there's times when I've seen tax bills double, triple, and even quadruple. Now, keep in mind, guys, if you're buying a single family home and you have a $2,000 a year tax bill, can it hurt you? Yes, but it's probably not going to cripple you. If you're buying a property that has a $100,000 tax bill and it triples, that will absolutely kill your numbers. So
Yep.
make sure that you reach out to the assessor in whatever area you're looking at and make sure that you understand when they're going to reassess, how they're going to calculate the reassessment, and whether or not a sale is going to impact when they reassess.
No, that's good. Especially when looking at what type of markets you want to focus on, because taxes vary, state to state. I mean, it can be significantly different.
Right. And even
So,
in the same state, they vary county to county. So always keep in mind, even if you're used to looking at deals in a particular state, if you're looking in a different area, make sure you reach out to the assessor and just understand what that process looks like.
That's good. That's good advice. All right. So, and you may have touched on this, but this is lessons into blessings. So we always, cap off with kind of what is the biggest mistake or lesson that you've learned over your years in real estate or underwriting. And you could speak maybe to even your students, kind of what are some of the biggest mistakes you see investors making, and what are the biggest takeaways that our listeners can glean from those?
Sure. So most of the biggest mistakes that I've made are probably because I'm stubborn. I like to learn the hard way. It's just how I am. If you tell me the stove is hot, I won't believe it until I put my hand on it, and I'm like, oh, okay, it is hot. So even though people give you all the advice when you're starting out, and I probably could have saved some time by listening to it, I didn't. I did most of the things that I shouldn't have done first. I looked in way too many markets. I just didn't have things perhaps as well organized as I should have. And for me, that's my learning process. So that's how I go through it and I learn.
Yeah.
So did that probably take longer than it needed to because of those things? I would say probably. So the biggest takeaways, I would say that there's really 4 things I would tell anybody if you're brand new and starting out. The first thing is you need to pick a target market. And you need 1 or 2 markets when you're starting out. So it could be a market that's near you. It could be a market that's elsewhere. In general, while you could do this from anywhere, I would recommend picking a market you can drive to. So maybe within a 4 to 5 hour drive. So could you live in New York and invest in California? Absolutely. Does it get a lot more expensive when you need to jump on a plane every time for something? It sure does. So it does make things a little bit more costly, and it also makes them a little more challenging. So if you pick a market that's within a 4 to 5 hour drive of where you are, that's probably a good starting point. What I would also tell you is that the reason you want to focus on markets when you're starting out is because 2 things. One is you get the advantage of knowing the market better. Every time you enter a new market, you're wasting time researching and learning the market.
Yeah.
Well, that's not necessarily wasting time. It is when you're doing it over and over again.
Yeah.
So the benefit to being in 1 to 2 markets starting out is you get to know those markets well, and that increases the speed with which you're able to make decisions.
That's good.
The second reason is because you're building relationships. So every single deal that I've won has been through relationships, every single one. So when you're entering new markets, you don't have relationships. So if you're constantly bouncing from market to market, you're, especially when you have no real track record, you're a low priority for those brokers. You're a low priority for people that don't know you. So it takes time for people to trust you and to build relationships. So 1 to 2 markets starting out is the summary there. Second thing I would tell you is you want to go out and you want to find partners. So when you're first starting out and you don't have any momentum, you'll be able to do investor relations, you'll be able to do acquisitions. But what you'll quickly realize is that as you build momentum, most people start in this business as a side hustle. and they're starting it because they have a full-time job. They're starting it because they have, a business, or they have something else that's producing income. And maybe they also have family obligations in life outside of that. So with all those things factored in, what you'll quickly realize is this can become overwhelming if you try and do everything yourself. Now,
Definitely.
that doesn't mean you should rush into a partnership, but you want to start looking for people that could be a good fit for you. So you want to know yourself, you want to know what you're strong at, what you believe in, and you want to find somebody that has a complementary skill set and also aligns with your values and beliefs, so that way you have some commonality there.
Yeah.
So make sure to keep an eye out for those people, get to know yourself, know what you're really good at and what you enjoy, and then find other people that you can see yourself working with to fill those gaps. Then the third thing is finding investors. So a lot of people think, oh, let me find the deal and the money will come. With a $100,000 single family home, that can be fun. If I go out and I find a $100,000 home, which is not that unrealistic in many cities in America, if I find a rundown wholesale deal, I could go out tomorrow and I could find somebody to assign that contract to, and I can get paid a wholesale fee. And that's, it's not that hard. But now let's say that you're looking at a $5 million apartment. So much different scenario. One, you need a lot more equity. If you have, a $5 million apartment, there's a good chance you're probably going to need $2 to $3 million of equity.
Yep.
So there's a lot more people that have $100,000 laying around than that have 2 to 3 million. So a second thing I would tell you is most syndications are 506B as in Bravo. And that means you need to have a pre-existing relationship with your investors. So legally, if I found a deal today and I met somebody tomorrow that I didn't know, I could not put that deal in front of them. Does it happen in the industry? I'm sure it does. But if you do that, eventually you're going to get in trouble. So you don't want to do that. So last thing I would tell you is key principal and sponsor relationships. So a key principal or a sponsor is somebody who signs on the loan for you as the guarantor. They have the net worth, they have the liquidity, they have experience, they have all the criteria that the lender is going to be looking for. So why are those relationships important? So in and of itself, is signing on the loan important? Yes. But the greater value to those relationships is as you build rapport with them, you could ask them, Mr. Sponsor, Mr. Key Principal, can I use your name and your track record when I speak with people? And most times the answer you'll get is a yes. Not always, but most times. Now, keep in mind, you want to ask that after you build some rapport. Don't ask that
for sure.
But after you have a good relationship with them, you could ask them. If they say yes, that gives you a major advantage. This business is totally a track record business. And when you're first starting out, you have no track record.
Yep.
So the sooner you can use somebody else's track record, the faster that's going to allow you to grow.
Yep.
So when you go to a broker and you speak to him, you say, hey, Mr. Broker, my name is Charles Seaman. I'm looking for my first deal. Or if I go to him and say, hey, Mr. Broker, my name is Charles Seaman. I'm working with Joe Smith, and Joe's got 2,500 units and I'm his local boots on the ground. You can imagine which one's going to get you a more favorable response.
Absolutely.
And then flip it on the other side. Same thing with the investors. Nobody really wants to be your first investor. Maybe mom and dad, if they really love you. But even they're probably a little skeptical, saying, okay, am I ever going to get my money back?
Right.
So once you can give that reassurance that there's somebody steering the ship that has the experience and has done this successfully, it puts people at ease and gives you a competitive advantage. So of those four things, I would actually say the sponsor and key principal relationships are the single most important one that would help somebody brand new be able to fast track their growth.
Right. Obviously, definitely tons of learnings. And I can say, even me jumping into the multifamily space, I try to do it kind of like you a little bit, just like, oh, no, I'll be able to figure it out. I've done real estate before. I should be able to transfer the learnings. And it tremendously helps when you have, someone who's been there before you and is paving the way, and you've kind of bought into that model, whether it's mentorship, you're buying into a program, but having that person where you can kind of mention their name and kind of beat the, clear the pathway a little bit. So yeah, that's definitely critical. So I agree on that one.
Good.
Well, thanks, Charles, for joining us for Lessons into Blessings. I know folks can reach out to you by email. I'll share that information if they want to join your Saturday call to learn more about just the nuances of underwriting and kind of walk through some examples. Is there any other way that you want people to potentially reach out if they'd like to?
Absolutely. You know what? As I was joking around before we started, I'm probably not as tech savvy as I should be, but just recently I got a Linktree link, and that has all the different ways to contact me. So what I'll do is I'll post that, and you can share that with the listeners.
All right, awesome. Will do. Well, I appreciate your time and joining us and giving a lot of those tidbits. And I thank the listeners as well for joining us for another Lessons into Blessings session. Till next time, stay blessed.